There are positive things that are happening in the stock market right now, and I'm going to cover those. Underneath the surface, there are some areas that are still of concern, and I'll cover those. So I see it as a mixed bag of positive and not so good in the stock market. I think it's important to see both sides of it. My name is Ben Reppond. Welcome to my YouTube broadcast. Today is May 2nd, 2023. I'm going to begin, I've got a few clips to play for you to show, literally I'm going to try to show the positive and the negative. Things that are people who are saying this market is going to go down from here, and others that are saying it's going to go up from here. And I'm going to try to explain the differences and nuances of both. So I'm going to begin with Kelly Evans in CNBC does an interview with Wolfe Research's Chris Senyek, and he describes, this is so interesting, that the market gains since the beginning of the year, 80% of the market gains have come from 7 stocks. So when you look at the S&P 500, this means that 493 stocks have accounted for 20% of the gain. If you translate that further, what that means is a lot of those are still negative for the year. Tomorrow I'll be covering the market sectors, the components in the market, and what I show there is somewhat what I'm saying here is of the 11 sectors in the S&P 500, of the 11, 7 of the sectors since the beginning of the year are up 2% or less. Actually less than 2%. 3 of the 7 are actually negative for the year. So you've got these leaders, not just sector of technology, but leaders within that sector that are pushing the market higher. And underneath it, you do not have broad confirmation that all the stocks are participating in this and the gains that have happened from the first of the year. So it's important to kind of see the where this is coming from. So I'll play this clip from Kelly Evans and Chris Senyek.
All right, Chris, let me turn to you because obviously I've seen the work that you're doing as well, trying to figure out kind of where the strength and weakness is in this market. And it sounds like you largely agree about the narrowness of the leadership.
Yeah, hi, Kelly. Thanks for having me on. Yeah, it's, there's 7 stocks driving 80% of the gains. The overall narrowness of the breadth in the market, to me, is not an encouraging sign. We have a situation where, the market's focused on earnings over the next week and in the past week, but then it's going to shift back to the macro with the Fed meeting and other inflation data coming up. And, inflation's running hot and is sticky. And ultimately, we think the Fed's going to be higher for longer. So the narrowness is, to me, not a good sign for the broader market.
Where would you, Chris, if you had to then kind of rule out certain areas that you think are overvalued, like tech, are there any that are fairly or even undervalued?
So one of the things we've been focused on is earnings quality within tech. So one of the concerning signs and signals to us within tech is they're laying folks off, and some of the mega cap tech companies have been extending their depreciation schedules, which has boosted earnings, we think, 8 to 10%.
Wow.
Most notably Google, or I should say Alphabet, in this most recent quarter. So within tech, given our defensive nature and bearishness of the overall market, we'd be in software type names, large cap names, like the Microsofts of the world that have posted strong results, but you got to be very careful. It's not going forward from here. I don't think it's just going to be buy all big cap tech and make money.
So the next part of that interview that Kelly Evans does, she does with Dr. Aswath Damodaran, and he is from the New York University Business School. And his approach is he sees that the economy is mostly positive, and he's pointing that out. However, when you listen to his words, you'll hear that there's actually kind of a negative tone to the market the stock market, while the economy he expects to do very well. In the technology sector, which has led the market, he says that 10% of the technology sector, so this is just one sector out of 11, and 10% of that sector has accounted for the entire growth in the stock market since the beginning of the year, 1.7 trillion. Now, the technology sector suffered, and actually this 10% suffered a loss of 3.5 trillion. So they have gained back about half of what they lost in 2022. But again, the gains are coming from a very small component of one sector. He believes that there is no recession ahead, and but he doesn't necessarily translate that to the stock market. He says risk capital has left the market in 2022, and his comment is it's not coming back. So that tells you that investors will be selective, and that the recovery in the market, at least, will be not broad-based, but probably narrow. So take a listen to Dr. Answath Damodaran.
Aswath, tell me kind of how you read the tea leaves right now.
No, 2022 was a year where risk capital went to the sidelines, and I don't think it's coming back. But at the same time, if you look at tech, the big money-making tech companies are the ones that are bringing the market back. I mean, collectively, this just in the last 4 months, the top decile of tech companies, the largest tech companies, are up $1.7 trillion. I mean, that's pretty much the rise in the market. They lost $3.5 trillion last year, so it's not like they're back to where they were before the market started its downturn. But I think the comeback has been almost exclusively in money-making big tech companies. This isn't a rally that's carrying all tech along with it.
Right, and that is telling to you, Aswath, because you're simply looking for signs that the rally could be sustainable, and you're not seeing that yet, are you?
No, and I think until we get some sense of direction on the inflation in the economy, you're not going to get a rally that is sustainable and broad-based. And I think we still have an incredible amount of uncertainty as to where inflation is going and how this economy is going to play out. And I think you can see it even the aggregate earnings forecast for the index is there's almost been no dent in it over the last 18 months, in spite of all of the talk of how the economy is heading towards a cliff. So either the analysts forecasting earnings are wrong, or the macroeconomists are forecasting that the economy is weakening is wrong. But I think that, but one thing to keep in mind with these big tech companies is even as they report higher earnings, they're also being very clear that revenue growth is now down to single digits. These are not double-digit growth companies anymore.
So the view from these two gentlemen was kind of a mixed view, positive and cautious at the same time. Now I'm going to go to the other side. I'm going to switch back and forth here. Go to the other side and show an interview that Adam Taggart does with Darius Dale. And Darius Dale is the founder of 42 Macro. And after he graduated from Yale, he worked for Hedgeye for 11 years and then recently founded his own company, 42 Macro. He has some interesting views. Now, this is a take that I have not seen before, and this is why I'm sharing it. He believes that the market will go down 27%, and I believe he's referring to this year. But the reason he's saying this is that he says what we experienced in 2022 was a liquidity cycle, and that we went through that liquidity cycle. Now he says what's next is the credit cycle. So we are now entering the credit cycle. Recently we saw Silicon Valley Bank and Signature Bank that experienced the impact of that credit cycle, and now New Republic. So there's Credit Suisse. There's other banks that are being impacted, and business, particularly small business, is being impacted by this credit squeeze. So he says from here or wherever the market goes to before it falls, maybe it goes up for another month or two, and then that becomes the high water mark from which it will fall 27%. He says we're not going to go back to the S&P 500 to 4,800 at the beginning of 2022. It'll be something more recent from which the 27% will be subtracted. So it's an interesting view. I've not heard this view of, the liquidity cycle and the credit cycle, but so from an economic standpoint, that does make sense to me. But I don't think he's a negative person. He's just saying this is part of the cycle that we're going to experience. So take a listen to Darius Dale.
Yeah, even if it's a mild recession, it's probably very likely that we see a new low in the market. And the reason I say that is because we have not even entertained the phase 2 credit cycle downturn in the asset markets. And so what that tells me is that if sector and style factor dispersion in the equity market is still very much not at all even entertaining the aspect of recession, that tells me that, what we typically see in recession, which is, kind of 28 to 27% drawdown in the S&P, we could easily see a 27% drawdown in the S&P from whatever price level we rally to this summer. And wherever the market is, when the market starts to get concerned about the phase 2 credit cycle downturn, that's when you activate, that kind of median 27% drawdown that you typically see in recession. And so I'm not concerned. We're very much preparing to see new lows in the S&P as a function of that. Again, where that is depends on the starting point, where you might be 3 or 4 months from now.
Now I want to play this. I'm playing both sides of things for you. This is positive and negative. So Arjun Kharpal does on CNBC, he does a breakdown of the tech sector, saying here's the positive parts of it that we're seeing, and here's the areas that are flatly negative, all within the tech sector. So I thought it was a really good breakdown for what's happening, what's, in my opinion, probably driving the market. So take a listen.
What a week it's been, Frank. Let me kick off with Amazon because they beat on revenue, they beat on earnings. AWS showed growth of about 16%, resilient in what is a very difficult market at the moment on the macro side and for cloud computing as well. Its ads business showed some strong growth as well, even with those macro concerns. But the issue was with the guidance. That's why you're seeing that move lower. The company guiding around 127 billion to 133 billion in revenue for Q2, just 5 to 10% growth. But the CFO warning that companies are cutting their spending on cloud, and that could be bad news for Amazon. It's saying that the April growth rates are already lower than Q1. So that is what sent its shares lower, that outlook, that guidance. Moving on to Snap. It was really bad news all around for the company. It missed on user growth. It missed on revenue growth. It missed on average revenue per user. And its second quarter internal guidance, as it said, was revenue of about $1.04 billion, which was below what the market expected. And secondly, Pinterest, it was good because it beat revenue. But again, that guidance was what brought these shares substantially lower as well. It's predicting about 4% revenue growth for the second quarter, again, below market expectations. The issue for both of these companies is this. The ad market remains very tough right now with business cutting back on ad spend as well. Now, Alphabet and Meta, given their scale, their size, their user base, they have remained resilient and managed to eke out a little bit of growth, even in this tough macro environment. These smaller players, Snap and Pinterest, are struggling at this point, and it doesn't look like they're bullish on the current quarter either, Frank.
Arjun, we heard from so many names this week. Give us the scorecard when it comes to tech.
Well, let me start with what I think were the top performers this week, and that was Microsoft and Meta. Microsoft showing its cloud business remaining strong but slowing, but it's showing resiliency, as I mentioned, in what is a tough quarter. Meta, meanwhile, showed its core advertising business back on track, even as its mixed reality metaverse division continues to pile up the losses. Investors happy with the fact that its bread and butter, its core ads on Facebook and Instagram, continue to come back. Where I'll put in the middle is Alphabet, I think, because it was a mixed bag. Yes, it showed a bit of resiliency in ads, but its guidance, again, said that there could be some uncertainty going forward. That's middle of the pack. Again, perhaps joining Alphabet, perhaps a bit lower really, was Amazon. As I mentioned just moments ago, it showed it continued to grow in cloud, but that outlook was uncertain. It said that companies are cutting back on cloud spend, which could have an impact. And at the bottom of the pile, certainly the worst performers this earnings season. Snap here struggling with what is a difficult ad market at the moment, and Pinterest as well with similar expectations. One thing I will say for this whole week is this, that expectations were low from the analysts, from investors going into these companies just had to meet or beat earnings. But I said at the start of the week that the key was going to be the guidance. And all of these companies, even the ones who performed really well, warned on some sort of uncertainty, some sort of belt tightening from businesses and spending on cloud and advertising going forward. So while there has been a rally in some of these names, I think investors are probably a little bit cautious at this point, given some of the outlook we've heard from these companies going forward, that the tech sector is not yet out of the woods, Frank.
So now, to give a balanced view of all of this, Mike Santoli from CNBC is interviewing Stephanie Link from Hightower, and she is flatly positive. She just says things are going up from here. And so I think that's an interesting view. I don't necessarily agree with that. I think we are going to see some downside from the market, and I think we're then going to see some upside. I don't know in what order, and I don't know when. But her view is more on the optimistic side. So for those that want to hear that side of it, I thought I would play this. I'm not saying she's wrong. I just think everything in each of these videos I played is all about time frame. So is the market, like Darius Dale said, going to go down 27%? Probably, but when? And is Stephanie Link's assessment correct? It's going to go up? Yeah, I think it is correct, but when? So that's the part that is sometimes difficult to assess. So take a listen to this.
Powell in March at the last meeting did say we're not seeing the evidence yet. We don't exactly know how to quantify it. But he also said we did consider pausing and not hiking in March. And so I wonder if right now we can be comfortable that another quarter point hike next week, maybe there's a signal that they're data dependent, or there's sort of the market takes it as a pause. And then we're left with an economy which, at least based on the data this week, seems to be holding up okay.
It's been amazing this week, right? In the face of all of these concerns, not only is it the bank failures and tighter credit and lending standards, but it's the geopolitical issues as well as the debt ceiling discussion or argument or lack of one. So in the face of all of this, and in the face of the Fed being very hawkish, you actually did get good data. You got better GDP, not on the surface, but underneath. Personal consumption up 3.7%. We know the consumer is 70% of the U.S. economy, so that's good. Initial claims are a far cry from the 370,000 weekly initial claims during a recession. They're at 230 this past week, so really good on the job front. And of course, inflation is coming down, Mike, as you know. It's definitely coming down from the peak, but it is still elevated, and that's the reason the Fed is going to go next week, and they could go the following month in June. We'll have to wait and see. But the bottom line is we're in the 8th or the 9th inning of the Fed hikes. They're going to keep rates high for a long period of time, but if they're at the 8th or the 9th inning, and to your point, if they're a little bit more dovish in their language, I think the market can go even higher. I think the market, again, has been so resilient in the face of all of this negativity. That's a good sign. It's led to much better than expected or better than feared earnings as a result.
Okay, now I'm going to switch gears. I've got a few charts I want to show you. This is one that I've shown before. This is a 150-year chart showing the historical perspective of the S&P 500 back to 1870. And there are several things going on here. First of all, this is a logarithmic, so it's based on percentage change, and that's a more realistic view. Secondly, there is a regression line that cuts through the middle of the data, and that shows you those components that are above when the market is above the regression line and then when it is below. It is inflation adjusted, and the red components reflect the bear markets, and the blue components reflect the bull markets. So there's a lot of data here. So the thing I wanted to show is that there have been 4 bear markets since 1870, long-term secular bear markets. And inside of those secular bear markets are cyclical, short-term bulls and bears, all within the long-term bear market. Same thing on the bull markets. There are, if it's a long-term bull market, you will see short-term cyclical bears and bulls in there. So at the very end, at the very far right, the upper right, you can see where we are today at the end of that blue data. The data actually, the chart goes down from its peak at the upper right, but that is in blue. We will not know until later, years later, if that, what we experienced for 2022 is actually the beginning of a long-term, 10 to 15 year probably, secular bear market. If it is, then that will turn to red. If you believe, and this chart reflects, that, oh, we're still in this upward trend and we're still in a long-term bull market, then I'm incorrect. But I believe we've entered a long-term bear market, and that this will in fact change to red. While we're in that long-term bear market, we will, like in periods past, you can see this through all of these red periods, that we will come down, we will attempt to go back up, and then it will fail and go back down again, and so forth. That will go on for 10 to 15 years, and that's based on the research that Russell Napier did from Scotland on long-term secular bear markets. So this, what I thought I would show you next is this year, 2023, where are we this year? So this is just a 4-month period. We know that last year was mostly a down market. It had periods where it tried to go back up and it would fail and go back down. Pretty typical for a bear market. This year, it is mostly a bull market, a growth market, but it has been marked with 3 cycles already. In 4 months, we've got 3 cycles. It tried to go up. It went up to about the first part of February. It just took off and did very well. Our models participated in that. Then in early to mid-February, the market began to decline. We got out of the way of most of that because that's how our models work. But you can see, went up quite a bit, went down quite a bit. And then it went up from early March to where we are today, and we're still in a short-term cyclical bull market inside of what I believe is this long-term secular bear market. So this just gives context to the comments that people made of they think it's going to go up, they think it's going to go down. All of that happens, in my opinion, inside of, as cyclical moves inside of this longer-term bear market. But that's where we are today. And I will comment, we have participated in most of this, the vast majority of this move up at the end, and we're still invested today. The other thing I wanted to show, I haven't shown this for a while, is shadowstats.com does a chart showing from 1980 to present the real rate of inflation when the adjustments and manipulations have been taken out of it. The government does adjust and manipulate the data. That's even admitted that they do that. And that's in the red line. So that is what's reported. So you can see it's reported that we are today around a 5% rate of inflation. That's a manipulated number. The real rate of inflation, when everything is left in instead of being pulled out of the data, if everything is left in, then it's more around a 13% rate of inflation. So if you're feeling like inflation is not 5% in your budget, you're correct. It's much higher. But that's the data that's been published through shadowstats.com, authored by John Williams, economist. The other thing I wanted to say, and this bears out the fact that we are in a bear market. And I hope and I'm glad that we're in a secular bull market and that we're participating in picking up gains in that market. But I am not kidding myself that this is going to go to the moon from here. This report shows that data. I'll make a comment at the end. This came out last week. The outflows of the market in equity funds, 5.8 billion. Inflows into bond funds, 1.6 billion. I mean, it says million, it should be billion. Money market funds have inflows of 53 billion, about 10 times the amount of outflows from conventional equity funds. If we were in a bull market, a new bull market that's going on up from here, this picture would not be this way. There would not be 10 times as much money rushing to the sidelines for money market. It would be flowing into equity funds if we were in a bull market. So this tells you, be cautious. You can participate however you want to participate, but be cautious and be ready to be defensive if that is what is called for. Okay, at the local lemonade stand, should a position open up, I'd prefer to work remotely. Okay, well, the decision maker will take that under consideration. So it is in some sectors, a difficult job market. There are jobs that are plentiful and in demand in certain sectors. I know certainly in the hospitality sector that's the case, but 300,000 technology workers have been laid off and are looking for work. So it's mixed. I think there's areas that are positive, there's areas that are not. So I try to just stay neutral. I don't want to be negative. I don't want to be positive. I want to just look at the data and report that to you, whatever it says. And to me, it's a mixed bag today. Thank you for watching. If you have questions or comments, leave them in the comment section below. Thank you.